Many Australians don't realise that selling your home later in life could open the door to boosting your super, even if you thought you were no longer allowed to contribute. This is through the downsizer contribution, and it may help you enjoy a more comfortable tax-free income in retirement. In this video, Kate Crawford explains how it works, who is eligible, and what to watch out for. Please remember this information is general in nature and doesn't take into account your own situation. If you find this guide useful, please remember to subscribe so you don't miss out when we publish a new video.
Did you know that selling a property you've ever used as your home could allow you to contribute more to super? This is called the downsizer contribution. In this video, we'll talk about the 3 scenarios when a downsizer contribution will allow you to add money to super that you otherwise couldn't, the eligibility criteria that you and the property must meet, and how to make the contribution. Your super fund won't deduct any tax from a downsizer contribution, and it's not tax deductible. I'll also take you through a real world example so you can see how the downsizer contribution works in practice. SuperGuide subscribers have access to a longer version of this video with more examples, including making a contribution from the partial sale of a property and using assets rather than cash to make a contribution to a self-managed super fund. To sign up for a membership, go to superguide.com.au and choose a plan. The circumstances when the downsizer contribution can allow you to put money into super that you otherwise couldn't is number 1, if you want to contribute more than the usual cap, number 2, if you're 75 or more, and number 3, if your total superannuation balance is higher than the transfer balance cap. Let's go through them one by one. The downsizer contribution doesn't count towards either the concessional or the non-concessional annual caps on superannuation contributions. So if you've already contributed up to your cap you plan to in future, or the total contribution you'd like to make is higher than the cap that's allowed, the downsizer contribution can help. If you're 75 or more, most types of superannuation contributions are prohibited. The only contribution type you can receive is compulsory amounts from your employer and the downsizer. So this really opens up an opportunity for older people to get more money into the super system to generate retirement income in a tax-effective way. Lastly, if your total superannuation balance on the last 30 June is higher than the transfer balance cap that applies for the current financial year, you're not permitted to make non-concessional contributions to super. However, you can make a downsizer contribution. So again, this opens up an opportunity for you to get more money into the system. To be a candidate for a downsizer contribution, you need to be 55 or more at the time that you want to put your money into super, and you can't have made a downsizer contribution before. So before using the measure, it is really important to consider if you want to use it straight away or if you'd like to keep it as an opportunity that you can use at a later time when you sell another property. There are no other criteria that you need to meet. There's no maximum age, no maximum super balance, and you don't need to be working. The property being sold also has to have certain characteristics. Most importantly, it must have been your home at some point. It may be your current home, or you may have lived there previously and since converted the property to an investment or a second residence. Technically, the definition is that the property must be exempt or partially exempt from capital gains tax using the main residence exemption. Or if it was acquired before September 1985 when capital gains tax was introduced, it's sufficient that it would be eligible for that exemption if it was a CGT asset. You need to have owned the property for 10 years or more. It must be in Australia and it can't be a mobile home, so no houseboats or caravans. It also needs to be in your name, your spouse's, or in joint names with you and your spouse. The maximum downsizer contribution is $300,000 per person and can't be more than the sale price. For example, if a couple sell a property for $500,000, they couldn't both contribute $300,000 because the total of $600,000 would exceed the sale price for that property. The contribution must be made within 90 days of receiving the sale proceeds using the ATO downsizer super contribution form to notify your fund of the measure that you're using to contribute. You can use the downsizer contribution even if your total superannuation balance on the last 30 June is higher than the transfer balance cap that applies for the year you're making the contribution. But the amount does count towards your transfer balance cap if you use it to start a pension. So you do still need to be watchful of how much you move into the pension phase. It's also important to consider that money contributed to super counts in Centrelink's means tests when you're 67 or more, or when you've used the money to start a superannuation income stream or pension. Before selling a property and making a contribution, it's important to consider how it will affect your Centrelink entitlements. Now we'll look to 3 very different scenarios when the downsizer contribution can come in handy. Now for our example, let's look at Terry. He's in his 60s and selling his home to move to his coastal investment property. He's long-term self-employed and only has a small balance in superannuation, so he's very keen to bump it up to improve his retirement income. Terry can use the downsizer measure to contribute more to super than he otherwise could. The sale price for his property is $800,000, and he contributes a total of $660,000 from that to his super. That's made up of $360,000 that will count towards his non-concessional contribution cap, and that will use up all of his available bring forward for a 3-year arrangement. You can learn more about the bring forward rule in our separate content for that topic. On top of the usual maximum contribution, Terry contributes a further $300,000 using the downsizer measure, getting more into superannuation to finance his retirement income. He'll also speak to his financial planner towards the end of the financial year when he knows what his taxable income is going to be. They will consider whether Terry should make a further tax-deductible contribution to super that will count towards his separate concessional cap.